we have, we don't call that revenues, okay? We call that income. Okay? And we don't call it expenses, we call it deductions. Okay? So then the income minus deductions, just like revenue minus expenses, okay? We call that taxable income. And company pay tax based on taxable income. Okay, for example, let's say they pay 10% tax rate, then 10% times taxable income. That will be the tax company need to pay. Okay, so again, we have two systems. One is accounting, one is tax. Okay, internationally, some country they have they combine those two systems. Okay, just a few countries they do like that. Okay, they don't, but in ours. In our country, okay, the US, we have two systems, okay, they are different, okay, but there's a lot of similarity, okay, a lot of similarity between GAAP and the code, okay, tax code, but there's a lot of differences, okay, that's why those pre-tax accounting income may not be same with taxable income, okay, there are a lot of differences, okay, so we say there are two kinds of differences. One is the permanent differences. So those differences gonna stay there forever. Okay, so forever the differences. Another difference is called the temporary differences. Okay, temporary differences is just timing differences. It's timing differences. So this year these two are different. Okay, but next year gonna reverse. Or next year gonna reverse back. So over these years, there's no differences. Okay, that's why we call it we call that temporary difference. Okay, so today we're going to focus on temporary differences. Okay, permanent differences we're going to talk about that next week. Okay, we're going to talk about temporary differences. We only talk about this part situation. Okay, temporary differences have two situations. One is accounting income initially. Okay, we talk about the first year. Okay, so we talk about the first year. First year accounting income greater than taxable income. Okay, another situation definitely accounting income is less than taxable income, right? So that's another situation. Okay, so only two situations, but we don't talk about this part. Okay, today we focus on the first situation. Again, this is the temporary differences because the difference is going to reverse. Okay, in the future period. Okay, will reverse in the future period. So let's say, okay, let me give you an example. For example, let's say accounting income, okay? So based on our GAAP, right? So we revenue minus those expenses. Let's say accounting income is 100, okay? It's 100. Or 100,000, okay? So make it real, okay? Like accounting income is 100,000. Accounting income is what? It's the profit, right? It's the pre-tax profit. Okay, we need to pay tax based on. Of course, we need to pay tax based on that, right? So this is the profit. Okay, this is the accounting income, revenue minus expenses. So how about the taxable income? Taxable income, let's say taxable income is only 80,000. Okay, so it tells us what? 80,000 is what? Is the tax we're gonna pay. Okay, we need to pay tax on 80,000. Okay, let's say we pay 10% tax rate, 10% times 8,000, you got 8,000, right? 8,000 should be tax we need to pay this year. That's called taxable income. Okay, it's based on the tax code. Okay, the federal government, right, to regulate. Okay, it tells us we need to pay let's say $8,000. Okay, this year. So that's a taxable income. So accounting income is $100,000. This is our profit. Okay, but taxable income is only 80. So the difference is what? It's 20,000. Okay, remember 20,000. We don't, this 20,000 differences is a temporary differences. Okay, so we don't pay tax on 20,000 right now, but we will pay tax on 20,000 in the future. Okay, so that's why $20,000 is called future taxable amount, which is this, right? You can see here, future taxable amounts. Okay, $80,000 is the taxable income. Okay, $100,000 is the accounting income. In this case, we made the profit $100,000. We need to pay tax right now on $80,000. Okay, and that $20,000 will be taxed on that will be paid in the future. Okay, so again, that's called temporary differences. And so the tax on the 80,000, let's say 10%, let's say 10%, right? So you got $8,000, okay? So 10%. So that $8,000 will be tax we owe right now, okay? So you can call that income tax payable, right? So corporation need to pay tax by March 15 next year, right? So it will be due, right? So that liability will be due by March 15 next year. And how about this $20,000? Remember, 20,000 is a future taxable amount. So we need to pay tax too, right? But not right now. Okay, we pay in the future. Let's say future is still 10%, which is going to give you $2,000, right? So that $2,000 will be our liability as well, right? It should be our liability because we have an obligation to pay tax, for $2,000 in the future. Okay, so that liability is called deferred tax liabilities. Okay.
Excuse me?
Yes, go ahead.
Oh, so why you need to save $20,000 for future pay? Why you don't pay like right now at the same time with 80,000?
As we at the beginning we talk about, we have two systems, right? We have accounting, right? We have a tax code. Okay, these two systems, there is some differences. Okay, so that's why the accounting income is not the same with taxable income. In this, accounting income is 100,000, taxable income is 80. Later on, I'll give you an example. Okay, you can see we talk about a lot of example. Okay, so you can see and what kind of situation they are.
Okay. Okay. Yeah. Thank you.
You're welcome. So, any other question at this moment?
Yeah, I just had one question. So, how did we get 8,000 and 2,000?
No, I just hypothetically give you those numbers. Okay. So
okay.
We're gonna talk about the example, then you can see how do we get those numbers. Okay.
Thank you. Yeah.
Any other question? Okay, if you don't have any questions, then we're gonna go on. Okay, we're gonna move on. Okay, so let's move on. Talk about this example. Okay, so now you can see that this is a real example, right? So then you can have some sense about this. What is accounting income? Why the accounting income is different from taxable income? Okay, so this company report pre-tax accounting income in those 3 years of $100 million. Okay, so then that $100 million for those three each year, right? 100 million, there's no differences, okay, between accounting and tax. Okay, taxable income is also 100. Okay, except we have this. This is the only difference. Okay, so in 2011 we had installment sales. Okay, we had installment sales. So total is $40 million. Okay, $40 million installment sales, and so the installment sales is what? Do you remember installment sales? So when we have the installment sale in accounting in 2011, we can recognize that installment sales revenues. Okay, what we're gonna do is you're gonna debit installment receivables for 40s. Okay, then we credit sales revenue for 40s. Okay, so that $40 million installment sales, we can recognize sales revenue in 2011, but then will be collected. You understand installment, right? So you're gonna collect in the future. Okay, so in 2012 you're gonna collect 10 millions. Okay, 2013 you collect that 30 millions. Okay, so 2012, what do we do when we collect 10 millions? You debit the cash for 10, you credit installment receivable for 10. Okay, how about 2013? Similarly, right? You collect the cash, you debit cash for 30s, you credit installment receivable for 30s. That makes sense, everyone? This is accounting, okay? Accounting, this is the rule of the accounting regarding the installment sales. Okay, so then let's talk about the accounting. Okay, if you look at the accounting, so because of this sales revenue, 40 million, right? So that's why in 2011, our pre-tax accounting income is 140. Okay, it's 100 plus that 40s. Okay, that's right. Total is 140, but remaining years is still 100, right? Remaining years 100. Okay, so remember every year is 100 except we have this special, additions. Okay, to accounting. So this is the pre-tax accounting income. Everyone's okay with that so far? Okay, so then let's talk about the taxable income. Okay, so that's the pre-tax accounting income. So then let's talk about taxable income. Taxable income, remember this, let's read it. However, okay, however, the installment sales, okay, installment sales, let me read this part. So the installment sale, however, the installment sales income is reported on the tax return when collected. Okay, so tax code says you don't pay tax, okay, in the year 2011, okay, because you haven't collected the payments yet. Okay, so when you collect payments in 2012, you pay tax on 10, then you pay tax on 30th, okay, in 2013. Okay, so so that's the that is the situation. Okay, so for the taxable income. Okay, so taxable income in the year 2011 is still 100. Okay, you don't include that 40 minutes. That makes sense. And then, but 2012, you're gonna include 110, right? Because you collect 10, right? You got the cash, you collect 10. That's why you should add it. Okay, 10 to the 100. Okay. So remember, remaining income is 100. And 2013, you add that 30th, right, to so that total taxable income is 130. So over these 3 years, the total income is 340, right? Total accounting income is 340. Total taxable income is also 340. Okay, so what do you see here? Total accounting income is equal to total taxable income. That's why the difference is it's only a temporary. Okay, that's called the temporary differences. Okay, temporary differences. Question on that situation so far? Do we understand that situation?
Oh, so for the table, is it a taxable income, right? It's not a accounting income, is it?
So see here, this is the accounting income, and this is the taxable income. Okay, so those are the 3 years. Okay, so accounting income, 3-year taxable income. I'm just explaining why we have those numbers.
Oh, okay.
Okay.
Yep.
So then let's talk about the journal. Okay, so then we understand the situation. Let's talk about journal in 2011. Okay, so 2011, what happened? The pre-tax accounting income is 140, right? So then taxable income is 100. So 140, you can see 100, you need to pay tax, right? So how about this 40? 40 is called the future taxable amount. Future taxable amount. So 100 is a taxable income, right? Taxable income. Okay. 140, of course, is pre-tax accounting income. So we pay tax on this 100 right now. So remember 100, right? This 100 times 40%. Let's assume tax rate is 40%. So 40 should be income tax payable. Okay, should be this, right? So you can see we should credit income tax payable. Okay, so this is one of the liabilities. Okay, so 100 times 40%. Okay, so then how about this 40? 40, you remember 40 here is the future taxable amounts, right? 40 times 40%. Let's say future tax rate is also 40. Okay, 40 times 40% equals 16. So 16 should be what? Should be the tax we need to pay in the future, right? So we have an obligation to pay tax on the future. We call that deferred tax liabilities. And then this one is the total. Income tax expenses is the total. Okay, so that is the journal entries. Any question at this moment? Journals. You guys okay with that?
So, Professor, yes, I have a question. The tax apply only for the first year, like the 2011. It doesn't apply on 2012.
Tax? What do you mean tax? Taxable income in 2011 is 100.
Yeah, okay. So you multiply by the
You're gonna pay tax on 100, 2011.
okay.
2012, you're gonna pay on 110.
Okay, so that was my question. Okay, thank you.
Right, so those are taxable income. Okay, so this one just make it simple. Let's assume each year it was $100, right? It was 100. Then we add additional the situation.
Okay.
Okay. Any other question? You guys good? If you have no question, we're gonna we're gonna do a little exercise. Okay. I'm trying to find out. Where's the one? Wait. Oh wait. I need to find out. Yeah, give me a moment. Okay, I need to find out the wait, come. Just hold on. Okay, let me get the files. Okay. We need to do some exercise. Okay. Let me just get the file for you guys. Okay, this is the one. Can you see this? The exercises.
Yes.
Yeah. Okay. Yeah. Okay. It's great. Yeah. So let's do this exercise. 16 that's one. Okay. This one. Okay. Let's work on this question. I give you a little time. Okay. To work on this. So then we can discuss. Okay. E16-1. So you need to figure out what is the pre-tax accounting income. Actually, it's given here, right? What is taxable income and what is the future taxable amount? Okay, and then you want to figure out what are those liabilities, right, related to those two items. Okay, and then you write a journal. Then you can figure out what is the income tax expenses, and then you can calculate what is net income, right? So that's what you're supposed to do. Okay, I'll give you a couple of more minutes. Okay, once you're done, and then we're gonna go over this question. Okay, guys, are you guys ready?
Yes.
Okay. Oh, you need more time. If you need more time, let me know. Okay, let's. Oh, wait. Let me. Give me a moment. Okay. Okay. Okay, let's talk about this question. Okay. So in this case, what do you see? The pre-tax accounting income is 400, right? 400. Okay, thousands, and the taxable income is 250. So you 400 is what? Is you made a pre-tax profit, right? You made a profit 400, but this year we're gonna pay tax only on 250,000. Okay, that's called a taxable income. That makes sense? Taxable income. But how about the remaining part? Remaining you have 150,000, right? So this one is called a future taxable amounts. Okay, you don't pay tax right now, but you're gonna pay tax on that on 150,000 in the future. So this 250 is what? It's called a taxable income. Okay, taxable income, because you're gonna pay tax right now. Okay, this year. Okay, again, this year tax on it's gonna be due in March 15 next year, right? So this is so that's why we have two liabilities. Okay, one is this related to the 250. So tax rate is 25%. You times 25%, right? So that's how we get. Let's see how we get how much we got. It's 62,500. Yeah, 62,500, right? So this is what? This is the so-called income tax payable. Okay, you need to pay tax, right? But again, it's gonna be due in a couple of months, right? So you should credit. Let me write the journal here. You credit income tax payable for 62,500. Okay, this is one of the liability. That's why you credit, right? How about the tax on this part? Okay, remember this 150 is future tax amount, right? You don't pay tax right now, but you have obligation to pay tax on this amount in the future, right? So let's say future tax rate is also 25%, times 25%. So that's giving you
87,500.
Can you mute? Can you mute, please? Yes, thank you. So then you got 150,000. Wait, no. 150 times 25%, you got a 37,500. Okay, so 37,500 is your liability. Okay, it's our obligation. Okay, we're gonna pay tax, right? That's our tax obligation. But we call that deferred tax liability. Okay, deferred tax liability, which is 37,500. So you have two credit. You need to have a debit called the income tax expense for the total, which is say $100,000. Okay, the total. So this is a journal you did at the end of the year. Okay, at the end of the year. That makes sense, everyone? Question on this part so far? Okay, if you don't have question, then let's answer these two required requirements, right? So first requirement, let's say what will be company's net income. So remember, pre-tax accounting income is 400,000, right? Then income tax expense is 100. So what is net income? It's 300,000, right? 400 minus 100. Okay, that will be the $300,000 should be the net income. Requirement number two, what will the company report in the balance sheets related to this is what? You have two liabilities, right? One is deferred tax liability. You're going to report 37,500. One is income tax payable, 62,500. Okay, so those two liabilities will be reported in the balance sheet related to this situation. Everything is okay? Any questions so far?
Can you repeat the question 2, please?
Question 2 said, you cannot see this question? Oh, you mean to explain. Okay. So question number 2 said what the company report will be reported in the balance sheets. Okay. In the balance sheets, there are two liabilities will be reported in the balance sheets. One is the deferred tax liability, right? One is income tax payable. So those are all liabilities will be reported in the balance sheet. Okay. Any other questions? Any other questions about this?
No, we good.
You're good? Yeah. You're good about that? Okay, so this is very simple situation. Just give you kind of a brief idea about what we what we talk about. Okay, so let's see. Let me go back to that PowerPoints. Okay. Wait, what happened? Okay, temporary differences, right? So that's what we talk about. Okay, and then we have these journals. Okay, that's what we talk about. Okay, so now let's talk about another method. Okay, so that was the first method. Okay, so another method is called the balance sheet approach. It's the balance sheet approach. Okay, so if you look at the balance sheet approach, this is still the same situation. Okay, same example. Okay, so we had that installment sales, $40 million. Okay, so what do we do here? You're gonna look at the balance sheet item. Okay, so which is one of the assets, the receivables. Okay, the installment receivables, right? Look at the item, because this item will be reported in the balance sheet. That's what we call the balance sheet approach. Okay, this is another method. So if you look at the receivable in 2011, in the accounting, we have 40 million, right, receivables. But how about the tax basis? If you do tax, remember the receivables, you don't pay tax on receivables. Okay, you only pay tax when you actually collect the payments. Okay, that's why tax basis is 0. The differences here is the 40s. Okay, so 40 is the temporary differences. Okay, so this is the accounting income greater than taxable income by 40s. 40 is the future taxable amounts. Okay, and the times 40% tax rate, so you got 16. 16 should be our deferred tax liabilities. Okay, so if you draw T accounts, this is deferred tax liability. Okay, so initially we should have 0 balance, let's say. So then, by the end of this year, it should be 16. So how to make it become 16? You should credit 16, okay, to this account. That's what we talk about the journal here, okay? So we credit 16, right? So we credit 16 to this account, okay? Credit to the deferred tax liabilities, okay? So wait, come back, okay? And then I can talk about 2012 and 2013. Okay, so even though we didn't talk about that in the previous approach, okay, but let me just briefly talk about that. Okay, so how about 2012? For 2012, now you can see the receivables right now, because you collect 10 millions, right? So receivable only going to be 30 millions. Okay, so the total differences now becomes 30s. Okay, so future taxable amount is 30 by the end of 2012. And then 30 times 40% equals 12. That means our deferred tax liability should be 12. So it should be 12. Sorry. It should be 12 now. Okay, how to make it become 12? You need to debit 4, right, to make it become 12. Okay, so that's why in the journal 2012, you're going to debit 4 to this account. Okay, and then of course you're still going to credit the income tax payable, right, based on your taxable income. And then income tax expenses will be the balance. Okay, how about 2013? 2013 now, because you collect $30 million, now the balance is 0, right, for both accounting and the tax. So now you have a 0, right, balance in the deferred tax liability. Okay, it should be 0. How to make it become 0? So you should debit 12. Okay, to this account. So in 2013, you have a journal, you debit 12 to deferred tax liability. You're gonna credit income tax payable, right, based on whatever the income tax, the taxable income is, and then you debit the income tax expenses for the balances. Okay, so this is the second method. But I suggest you still stay with the first method. Okay, I think the first method probably is relatively easier. Okay, to understand. Okay, you better stay with this method. Okay, we can focus on this method. Okay, this method is just for your reference.
So do we have a balance sheet method in the exam?
Let's say I will say no, because these are just 2 methods you can use. We don't, in the exam we won't ask you like you use the balance sheet approach. No, we're not. You can just use the previous the method. Okay.
Okay, thank you.
That makes sense. Okay, but the balance sheet approach just help you to understand these issues more, right? So you from different angle to look at this issue. Okay.
Okay.
Yeah, it's better to know this method, but if you don't, then that's fine. You just focus on the first method.
Okay.
Okay. But I think we have homework questions regarding, like a balance sheet approach. Okay, so you may some solution look at that solution, so you can just try to help you to understand that part. Okay.
Okay.
So, any other questions so far? Yeah, if not, let's talk about this. This is like a summary. Okay, it's like summary. The whole chapter, okay, but we put it here earlier, so we're gonna come back this probably a lot of time, many times. Okay, so what do we talk about? We talk about this, right? This is the situation. Installment sales, okay. Installment sales as one of the revenues will be reported in income statement now, but on the tax return later, right? Because tax return, you're going to include those only when you collect the cash payments, okay? Then you pay tax. Okay, so you can see that's situation, okay? So in this situation, that makes our accounting income is greater than taxable income. That's why we have those the differences, the future taxable amounts. And then we have deferred tax liabilities. Okay, so that's what we talk about, right? We just finished that example. Okay, and another situation is this situation, okay? We're going to talk about this situation. This situation is to talk about the expenses. Those expenses reported on tax return right now, but in the income statement later. That makes what? Because they reported in the tax return, that's why taxable income is going to deduct those amounts, right? So that's why taxable income will be less than accounting income. So accounting income greater than the taxable income, then you have a future taxable amounts. Okay, so both situations, this is the first situation, right? This is the second situation, right? So in those situations, you're going to see our accounting income is greater than taxable income. Okay, that's why we have future taxable amounts. And then that's why we have this called the deferred tax liabilities. Okay, so then, deferred tax assets, we're going to talk about that next time. Okay, so I don't want to confuse you. So just focus on deferred tax liability today. Okay, so let's work on this. Okay, let's work on this situation, the depreciation situation. Okay, show you another example. So this company purchased $60,000 of equipment in earlier January 2021. So the company estimates the equipment has a useful life of 3 years. Okay, and then we depreciate the equipment. We use the straight line method. So that each year we're going to conduct depreciation expenses 20, right? So $20,000, okay, for those 3 years. Okay, so that's what we do like this. So let's assume our accounting income is $100,000 for all 3 years. Okay, just make it simple. Okay, all 3 years accounting income is 100. And then we know depreciation expenses is 20, right? 20, okay? So remember 100 is what? It's already after 20, right? So you subtract, how to get this pre-tax accounting income, the 100 is what? For each year, the revenues, you subtract all of the expenses, right? That one of the expenses is the 20, right? 20 is one of the expenses. Okay, so you subtract that, that's how we get 100. So first thing we're going to do is we want to calculate, let's say we want to exclude the depreciation. If we exclude depreciation, then each year the pre-tax accounting income is what? Will be 120, right? 120. You add it back, right? So add it back. Everyone's okay? So we want to exclude that $20,000 depreciation expenses. Then what will be our income? It should be 120, right? Remember, that 120 will be exactly the same for accounting and for tax, okay? Because the depreciation here is the only difference, okay, between the accounting taxes, which is assumed like that, okay? So this 120 is also taxable income before the depreciation. That makes sense? Before the depreciation, okay? So then let's look at depreciation in the tax, okay? So tax rule allows company to take entire amount deduction for the cost on 2021. So for 2021, we can deduct the entire amount, means you can subtract that 60s, okay, in 2021, the entire amount. So how about the rest of the years? You don't subtract anything, right? Because you should already subtract 60s, okay? So that's why the differences here is a taxable income, right? Taxable income should be 60, right, in 2021. Then 120, 2022, 120, 2023. This is the taxable income. Everyone's okay with that so far? No question on this part? Let me give you an alternative way, okay, to calculate this. Okay. Let me read this part. Everyone's okay so far, right? So that's how we get this 60, 120, 120. Okay, so based on the so there's a two methods here too, right? So what we're trying to do, we're trying to figure out what is taxable income. Okay, so this is the method I just talk about is probably, I think, is easier method. Another method is this. Okay, another method is this. We try to figure out what is the differences. Okay, differences between accounting and the tax. So differences here, accounting and tax is what? It's -40. Okay, so for 2021, right? Because in accounting we only recognize depreciation expense of 20, but in tax we deduct 60. Okay, tax deduct more, right? 40 more. Okay, 40 more. So that's the differences. And then what is accounting income? 100, right? So that's why taxable income should be 60. Okay, 100 minus 40. Then you got a 60. Okay. So how about the year 2022? 2022 similarly, right? So the differences is 20, right? So now what is the total taxable income? It's 120. 2023 is what? 100 plus 20, you got a 120 again. So those are the taxable income for those 3 years. That makes sense, everyone? About those 3 years?